Good morning, good afternoon, good evening to our global audience. Welcome to Toronto Center's second episode of Pandemics and Financial Stability. I understand we have several hundred people who've joined us. This is very encouraging. We had a very exciting session last week with a very important message from the WHO and a prominent supervisory authority who's a member of Toronto Center's Board of Directors Advisory Board for Insurance and Pensions. The key takeaway of that first session was we must listen to public health officials. This is serious. Second, we all need to have robust business continuity plans. And that's not just financial institutions and supervisory authorities. I think we all are seeing that in various sectors of the economy. Finally, we must bring unprecedented resilience to these times of uncertainty as we apply the difficult lessons we are learning every day. The coronavirus is rapidly rising. The latest count in the US now has surpassed 46,000. Canada has surpassed 2,000. And one of our speakers here is actually in Lima, Peru. They have, their cases are approaching 400, which is the number Canada had in less than 10 days ago. So we're all in this together. But it's not just about the pandemic and the virus. Global economic anxiety about uncertainties of the impact of coronavirus continues. Just very recently, the president of the US Fed in St. Louis said that if nothing is put in place to mitigate the impact, the unemployment rate in the US in the second quarter can rise up to 30%. That's a staggering number, but to put it in perspective for you, the unemployment rate in the United States during the Great Depression at its height in 1933 was 24%. So you can see the dynamic here. We have two very qualified and internationally renowned experts. Before I introduce them, I would like to thank Toronto Center's key funders, Global Affairs Canada, Swedish International Development Cooperation Agency, the International Monetary Fund, Comic Relief, and Jersey Overseas Aid, without whom we could not bring you the programs that we have today in the virtual realm. Our two noted economists and speakers have tremendous international experience. I'm not going to read their full bios. You have them, and we're also posting them on our website, but I should say something very briefly about each. Ms. Socorro Heysen is the current Superintendent of Banks, Insurance, and Pensions in the Republic of Peru. She's also a member of Toronto Center's Board of Directors. Formerly, she worked at the Central Bank of Peru and a senior official at the International Monetary Fund. She holds a master's degree in economics from the UCLA. She's a fantastic speaker. Vincent Reinhart is Mellon's chief economist and macro strategist. In this role, he's responsible for developing views on global economy and making relative value recommendations across global bond markets, currencies, and sectors. Previously, he was chief US economist and a managing director at Morgan Stanley, resident scholar at the American Enterprise Institute. He was in the US Federal Reserve System for more than 24 years, including with responsibilities at the Federal Reserve Bank of New York, which is at the forefront of supervision of financial institutions. And he is a noted academic with numerous publications with a graduate degree from Columbia University. So without further ado, I would like to go to our speakers and ask each of them a very basic question. Each of them has seen many global financial crises and other crises throughout their careers. So let me just ask you each. Vincent, how is this crisis different?
I haven't seen a crisis like this in my lifetime. I don't think any of us have. And it's for a couple of reasons. One is we're getting the disruptions to economic activity first without the associated kick of a wartime economy of mobilizing resources. And second, it's both advanced economies and emerging market economies. Usually the global plane has one engine still firing. They don't all sputter at once. The last time this happened was in the Great Depression.
Vincent, much of the impact of the coronavirus has thus far been directly on the real economy rather than through the financial system. This impact has varied considerably by country and region. These impacts may be temporary, but they will not necessarily be reversed rapidly. What is your view on a long-term negative impact on the real economy and to the global financial sector in particular?
So I think there are two parts to that answer. The first is we're definitely on the downward slope, both in terms of our vulnerability to the infection globally, the disruptions to economic activity as we try to mitigate that, and the withdrawal from risk-taking that is associated with big capital losses on global markets. The problem is that is exposing weaknesses on corporate and national balance sheets that could lead to permanent losses, businesses closing, countries defaulting, and that's a permanent scar. The second part of it is, I don't think we will get out of this with the same attitude toward globalization. We will be much stricter at borders. We've seen already that the notion of a single market in Europe gets broken down if it involves shipping medical supplies across the border, that countries have closed their borders, and that's going to be a feature of our future. Less globalization, harder borders.
Socorro, if you can hear me, what is different about this crisis?
Okay, well, let me first start by emphasizing that this is an unprecedented, true global event, just as Vincent mentioned. There's a lot of things that are different from this crisis regarding the 2008-2009 crisis. I mean, starting for the most obvious, the financial systems and the regulatory frameworks and the supervisory agencies are in a stronger position right now, or were in a stronger position than before during the previous crisis. Also, the origin of the shock is different. The origin of the shock in this case is not the financial system, but from outside of the financial system. And because of that, perhaps financial regulators and authorities were not prepared or had not thought of a scenario like this at all. But I think that the most important difference is the high degree of uncertainty that we have to deal with. In any crisis, there is a high degree of uncertainties, and authorities have to make decisions with incomplete information and a high degree of uncertainty. The difference here is that uncertainty here, the sources of uncertainty are more diverse and could be very difficult to grasp for economic and financial authorities because it's not our field of expertise. And in this case, we have to coordinate, we need intensive coordination among ourselves, of course, as usually, domestically and internationally, but also with other government authorities that are in a different field and that generally we do not communicate with them, or we have not found a need to communicate, like health authorities or police authorities. So this presents new challenges. And let me stop it like that with my answer to your first question.
That's great. Thank you very much for that answer. It was very succinct and to the point. Also like to let our audience know that you have a chance to ask questions. If you would like to ask any questions, please use the Q&A function, and the questions will be fed to me, and I will make sufficient time for as many questions as possible to be read. So Socorro, let me ask a follow-up question to you. You already touched a little bit on that, but this is a chance for you to elaborate a bit more. So supervisors currently should monitor economic and market developments, monitor the solvency and liquidity of individual financial institutions. In fact, they do this all the time, intervene as necessary. So a lot of important core roles for supervisors just on a daily basis. Now, in the context of the coronavirus, what issues have arisen or may arise for financial sector supervisors in these core roles?
Let me say that we had to rebalance our supervisory activities and priorities to deal with this crisis. We had to stop some of the, well, of course, we had to stop altogether on-site activities for obvious reasons and reduce some of the reporting and focus on things that are more relevant for resolving the short-term challenges of this crisis and for addressing the long-term issues that may be arising. The first thing, we have to focus on monitoring the operational capacity of financial institutions to be sure that they can operate in a proper way in this context. There are, for instance, in our case, several difficulties for financial entities staff to reach their locations of work, their work locations, and that made it difficult for some bank branches to open, or also the most important problems were with service providers, because they were initially not considered as priority sectors. Service providers like IT service providers for banking institutions, or call centers for banking institutions, and the staff could not reach their locations, and that created choke points especially in answering clients' questions and requests, because in case of banks, for instance, lots of clients were calling to reprogram their loans or refinance their loans, and the call centers were not working at the necessary level at the beginning. The same thing happened in the insurance company, in which citizens were calling to ask for health coverage. And they had lots of questions, and if call centers were not working properly, there was also a choke point there. Fortunately, these issues have been resolved. The second issue that we're dealing with is a close monitoring of liquidity issues. Changes in liquidity patterns, changes in deposit withdrawals, and bank revenue. And this affects not only banks, but also insurance companies, because of some of the delays in collecting premiums for insurance, which can cause liquidity problems for insurance companies, but also, and more importantly, it can cause problems of lack of coverage if not addressed promptly for people in the time in which they most need it. Third is the monitoring of credit risk. We have to look at carefully at bank portfolios and create specific reporting for all and more frequent reporting for refinance loans, and to understand what is going on over here with credit risk, and also monitoring the new credit granted to see if the flow of credit is moving at the correct speed. For instance, in the first week of isolation, what we had is that several microfinance institutions that rely a lot on person-to-person contact for granting credit were operating at 1/10 of their normal credit flows. And the last issue that we're monitoring, of course, is the value of financial instruments for all banks, but mostly for insurance and pension funds which have very large portfolios of financial instruments. Another important issue is the coordination among authorities. We are working very closely together in the Financial Stability Council, and also in close contact with the industries at different levels of staff, and also providing information to the public, either through our social media or with a special section that we have created in our webpage, for instance. And well, all these are issues that have arisen, the need to lift some of the prudential regulations, but I think you're going to ask about that later on.
Yes, thank you so much for that, and the degree of disruption is big. Vincent, I'm going to turn back to you. Coronavirus and its impact on the real economy also affects the financial sector. This is very real for all of us, real economy, financial sector. For many of us, it looks like our retirements are going up in smoke. I have family and many friends who are owners of small businesses or professionals who have been forced to lay off their key staff and members. So, the impact is real. This has included sharp falls and greater volatility in equity and other asset prices. We see that on a daily basis with Dow and NASDAQ, everything. A deterioration in many borrowers' credit worthiness, et cetera, et cetera. What are the early lessons so far
So the early lessons is if you disrupt economic activity, even if it's for the good cause of mitigating the spread of a virus, it can have relatively immediate and painful effects on lots of business models. Something like 45% of US workers are at firms that are under 250 employees. They don't have the resources to withstand much of an outage. And this is more than just a short outage. It is a serious disruption to their way of life. Meanwhile, there's been a withdrawal from risk-taking. I think the surprising thing is the extent it has also been a withdrawal in risk-taking by key intermediaries. So there is less linking of markets across different instruments and across different countries. Essentially, big banks are husbanding their reserves, trying to keep within their regulatory guidelines, capital and leverage, and they're not taking the opportunities to smooth bumps in markets. And so we're having more bumps in markets. So part of the reason volatility is higher is markets are just that much less efficient. And I think, you know, there's a back office issue as well, and that is everybody had their own resiliency plans, but nobody really appreciated what would happen when everybody did it at the same time. And so when you have traders working from their kitchen, when you have less resources, you're just finding out that markets are functioning more poorly.
Yeah, that's true. And even forget about the markets. I mean, just looking at ourselves, we are trying to deliver a lot of programs and services online through the virtual domain. And I think we're not the only one. Everyone's trying to do that. And just the pressure on the telecom system that provides the internet must be staggering. And we're just going to get into that. So I think, you know, can identify with that. Socorro, coming back to you, the coronavirus outbreak demonstrates the importance of business continuity planning by supervisory authorities and regulated financial institutions, crisis preparedness, and crisis simulations. In fact, in our first episode, as I mentioned earlier, business continuity planning was the #1 issue that a lot of supervisory authorities were asking questions about. So you are actually living your business continuity planning right now in your own institutions under difficult circumstances. What should be the supervisory response to increased working from home by regulated financial institutions? And similarly for supervisory authorities, what is their capability for effectively carrying out their own responsibilities in light of working from home, accessing confidentiality, decision-making, communication with regulated firms, and with other authorities? Just to give you an example, just yesterday, my own wife needed some personal information about one of our daughters for the return, filing the tax system, and she couldn't get a hold of the bank. She tried so hard all day, and this is a bank in Canada, right? So you can just see the dimensions of this. So I would appreciate any insights you may have on this, please.
Well, I think we have, first, let me start with financial institutions, remote work. I think we have to allow remote work in this circumstance. But it is more likely to work if prior arrangements have been done, like bank continuity regulation and clear mandatory testing of business continuity plans and comprehensive supervision of these plans and the testing. All these supervisory prior actions should have included service providers to be sure that service providers provide adequate security and for the continuity of operations in this circumstance. If the financial system did not have this prior, they're going to have a very, very difficult time operating remotely under this circumstance. In our particular case, we have found that about 50 or 60% of the key staff of financial institutions are working remotely at this point in all large institutions. And this number grows up to between 70 and 100% for the insurance industry. There are some issues that we have to consider. Clearly, there are some activities that cannot be executed remotely, either for the type of business model or for security reasons or for other reasons. As I mentioned before, the difficulties that microfinance industry is having in granting new credit because of the business model demands for person-to-person contact to assess the capacity to repay of the borrowers. And the same layers of control that the microfinance risk management systems have also require supervisory on-site visits to the business. And if the businesses are not operating, therefore the credit cannot be granted. But so that's the first thing. The other thing is some of the remote activities cannot be carried out for long periods of time remotely. One thing is to operate remotely for a couple of weeks, and another thing is that you're going to operate for 30 days, 60 days remotely. Many of the activities are going to suffer tremendously. The other thing is that technical and technological capabilities have to be continually tested. And of course, during the emergency response, the most important thing for financial entities is to be aware and careful about the health of their own workers. And this limits the operation of some of the channels of the banks. For instance, they have to have protocols, what to do if a bank employee becomes infected with the virus. A couple of branches in some banks in Peru have had to close because of that reason. And then, of course, the role of supervisors in this context is to continue looking and monitoring the operation of the system and be sure that the system is addressing all the problems that they may have in. And we have done that in the early days, and now the operation of the system is improving. But as I said, this is something that can be done on a short period of time, not on a very long period of time. That from the point of view of the banks. From the point of view of the supervisory authorities, the capacity to work remotely also will depend on some prior arrangements that people may have done earlier. To have enough laptops for the supervisory staff, secure communication protocols, cultural issues management, proper organization to manage the workflow, and key identification of the key staff and alternate personnel in cases the key staff is not available for any reason. So strategies, it's optimal that strategies were developed ahead of time to consider all these issues. In our particular case, we had prior testing at some department levels, but not as a strategy of the whole organization to operate remotely. So once isolation was declared, it took us one full day to have all the critical staff operating fully remotely. We are learning along the way. The first day of isolation, as I said, most supervisory staff still came to the office. And this day was used to address all the urgent issues like allocating the laptops, the remote access permits, confirming that all the laptops, iPads, phones had the necessary software, reminding everybody of the security protocols, among others. Our IT staff worked very hard to get us up and running remotely very quickly, and we are very happy about that. On the second day of our isolation, about only 40 supervisory staff went to the office, and now about 10 people out of a staff of 1,000 people are in the office at this current time, some of them helping me resolve the technical issues of this webcast. So fortunately, we do not have staff infected by the virus. but we have established protocols for this event, and we have succession plans and alternate staff to replace key staff if necessary. And that's what I would like to say about this.
Thank you very much. I think what you're underscoring is how much you are actually deep in the trenches. This is a real situation. As I underscored, you are living your business continuity plan. And we're beginning to get questions from the audience, so I'd like to shift to them. There's one comment I'd like to read, and a question I'm going to pose to Vincent. A comment from one of the viewers is, this crisis highlights our ever-increasing reliance on sound or robust IT infrastructure. We need it for financial transactions and relationships, but also for the delivery of care. I couldn't agree more. So Vincent, this is a question that I think I heard echoes of it in our first episode as well. It's kind of unfortunate that this crisis broke right in the aftermath of the dismantling of the world, at least steady efforts to dismantle the world global trade infrastructure by certain countries and world leaders. So the question is, in the context of hardening borders and shift away from a distinct globalization from previous years, how do you perceive further developments of the existing business networks, both real economy and financial system perspectives? It also, in my view, touches on the fact that the global coordination seems to be a bit either lacking or weak, at least in the early stages of this issue. But bringing it back to the business networks, what is your view? What's happening here at this point, or what will happen?
Well, I think in some sense, all the tariff wars and trade disputes of the prior year and a half was a test run for understanding what happens when borders close. Now we're seeing it in real time and in a much more intense fashion. Chances are, given everything we've learned, supply chains are going to be less crossing national borders, because you can't be sure whether you can always cross that national border. And they will also be looser than previously, i.e., no manufacturer reliably should get all their product from one province in China. So it's a looser, more interconnected supply chain, more country specific, more looking for obvious regional friends. And I think that's going to be a more permanent feature of that network. I think also, do not be surprised if we see more capital controls, that governments on the back end of this will have much more debt. They will have to fund that debt, and they will have central banks that will be seeking to renormalize policy whenever that time comes. They are going to be uncomfortable with the free flow of capital, and so in some sense, we're going back. We're going back about 70 years.
That was a very sobering account, and very unfortunate, as I said, the timing. Socorro, this questioner actually mentioned you by name, so I'm going to pose the question to you. A joint statement was released by a central bank and bankers association, which gave specific steps to be taken by financial institutions, which included moratorium on loan payments. Do you think this sort of thing is a wise choice by the central bank to provide such details with the public rather than have such discussions with their licenses? And just for our viewers, I'm reading everything raw as it comes in. Socorro, over to you.
Well, first of all, it was not the central bank, it was the supervisory agency, the superintendency of banks. And let me say that we financial regulators are very reluctant to use regulatory forbearance, and for good reasons, because regulatory forbearance comes with a degree of opacity, which in turn can affect market discipline and encourage moral hazard. But having said this, if there is a time for some regulatory forbearance, I think this is it. This is it because in this period of high uncertainty and market volatility, it is very difficult for institutions and supervisors to determine the value of loans. It is not possible to assess what proportion of this shock is temporary, what proportion of it is permanent. And in time, financial markets are likely to recover part of the value lost. Some of the capital flows will be reestablished with some limitations, as Vincent mentioned. But so it is, and some companies will recover, and many companies will recover, some of them with fiscal supporting measures. So it is important to give time for the fiscal measures to kick in. For a time, we're not going to be able to know what the new normal is. And therefore, at this point, in my view, some degree of forbearance should be expected from authorities in the short term. And this should be limited, controlled, temporary, and well coordinated with other financial and economic authorities. The statement that we measured had to do with not declaring a moratorium of debts. That's not what we did. What we did was to allow financial institutions to refinance their debt, their clients' debts, on two different fashions, either on an individual one-to-one basis or on a massive group basis, and continue to accrue interest and maintain the classification. This is not a mandatory order from the superintendency. It is just an allowance. What that would facilitate banks to make decisions not considering the short-term regulatory impact. Of course, if after this there is some long-term impacts, then other type of measures have to be taken. So this is a matter of policy mix and sequencing.
Thank you for that. Yeah, it is a difficult decision for sure. Vincent, I think this question is probably better addressed to you. A viewer is asking, do you see any permanent changes to the financial system as a result of COVID-19? If yes, what are some of the changes that you foresee?
So I think there's most likely will be permanent changes because this is a very big shock. As I said earlier, at the other end of this, governments will have a lot more debt and they will be at pains to finance that debt. They will resort to a phrase my wife uses a lot, financial repression, using regulatory powers to keep interest rates on their ample amount of debt as low as possible. That's a permanent feature. We will probably also be somewhat more leery of algorithmic trading because part of what's happened over the past few weeks is that model-based trading hasn't worked particularly well. And in that environment, we're back to people speaking to people making markets. That sort of learning process is not usually forgotten all that quickly. It will be forgotten, it usually is. I think thirdly, our relationship with the central bank has been changed permanently. There was a ratchet up in what the Fed was willing to do in terms of outright purchases in 2008 and 2009 with quantitative easing. There's been a further ratcheting up in terms of the types of assets the Federal Reserve will acquire and the counterparties the Federal Reserve will deal with. And the reality is when a policy institution takes one step forward, it's extremely difficult to go back. The Fed has set a precedent. Ben Bernanke set a precedent. Jay Powell has set a new precedent. The Fed is going to be more interventionist, more active in a lot of credit markets, not just government securities, but credit across the board.
Thank you very much for that. Something that we need to think about. In fact, we're going to do some further follow-up with you on that question later on. And Socorro, for you, this question speaks to the anxiety of the pensioners, probably those who are about to retire now or collecting retirement. So the question is as follows. In light of the downturn in the global markets and the investment losses resulting from COVID-19 pandemic, what are your thoughts on government bailouts to the retirement funds in the form of payouts to the retiree members at their values prior to the downturn of the market? And then the questioner asks further on, the retirement funds will then repay the government at the point the markets return to normal and investment returns are back to pre-COVID-19 levels. What are your general thoughts on that?
In my experience, financial, the profitability of pension funds has to be looked at in the long term. And it is very difficult to look at the value of the pension funds at one point of time and expect it to be okay in a situation like this. In our particular case, there have been prior crises like the 2008-2009 crisis in which the value of pension funds suffered an important reduction. Also during the trade discussions between China and the US, there was an impact, and they have always recovered. So I think that it is first, in our case, it is important that people do not make quick decisions and realize losses at a time like this. Second, regarding the possibility of government bailouts, this is not a policy that we are considering at this point. I think that the government should also wait and to see what is the new normal, what is going to happen, and policies will develop in time if needed, but at this point I would not do anything like that.
Thank you for that. And turning back to you, Vincent, this questioner asks, we hear about the impact the government's response is having on the real economy, particularly small business and employees. They are on the front lines and hardest hit by the measures designed to spread the spread of the virus. How close are we, however, to large financial institutions beginning to fail? And we all remember 2008. For example, due to unrecoverable loans and defaults, are financial institutions beginning to plan how to manage such losses, including how to work with lenders with a longer-term view?
So they must be, or they should be. It's easy to understand why small businesses, particularly in service areas, are facing enormous constraints, especially because they probably don't have that many resources to smooth over even a short-lived disruption. But there are a lot of large businesses that are undiversified. An airline company being the classic example. All they do is fly planes, and if travel is disrupted, then their entire business model is at risk. The same is true for many parts of the hospitality industry, gaming, hotels. So there are a lot of large businesses that are definitely facing some constraints. In that environment, they will have trouble with repayment. The first option obviously is reprofiling, delay in interest payments. We've been emphasizing the companies and industries most directly affected by the disruptions from the mitigation efforts. But remember also that commodity prices have fallen because an important cartel couldn't manage supply given the big weakness in demand, i.e., the Saudis and Russia are at odds and oil prices are trading in the low $20 a barrel. That has been a severe blow to the US shale oil industry. And if oil prices stay as low as they are now for the remainder of the year, we would expect to see a considerable number of bankruptcies. There is another example of industry that's not diversified. And there are also banks in those areas that aren't diversified. They do a lot of their loan book to oil and gas exploration activities. So yes, there is going to be financial distress. It's going to be at the small level, the medium-sized level, and it's now going to be affecting banks.
Thank you. And Socorro, for you, so given the question is, given the rise in cyber risk and AML, anti-money laundering, counter financing of terrorism concerns, I guess as we move more and more to the online environment, how do these risks can be minimized by regulators, supervisors, national authorities, given the move to telecommuting and working remotely? So it's a pretty astute concern.
In this particular moment, if regulators and financial institutions have not done their homework, there are very limited tools to address issues like this. I think we have to rely on prior arrangements that have been put in place for situations, not this particular situation, but something like this, and supervise those prior arrangements and hope that they are going to work.
That's good, to the point. Vincent, this questionnaire is kind of futuristic. I guess this question falls in the ranks of a crisis is a horrible thing to waste. It says, do you think this situation is going to change the business model of some financial institutions? Is this an opportunity or threat in the long term? How do you see the landscape changing?
So it matters. There will be, in any big shock, there'll be winners and losers. The winners are those who are more technologically adept, who rely more on linking employees and customers by internet, that don't need a physical presence and can roll out more activity and get more revenue relatively quickly. The fact that Amazon is out there trying to hire 125,000 extra people tell you that there's an opportunity. The fact that Walmart is hiring 100,000 people tells you that there are also opportunities amidst what is considerable hardship. Probably also means there'll be more concentration. Go back to the oil and gas exploration industry. It will be harder for the small and medium-sized firms the longer low oil prices persist, because their main asset is in the ground, and that's what they use as collateral. So you'd expect some consolidation in that industry. So it probably argues whether or not you like that trend for bigness, for technology, and for lack of physical presence and more digital ones.
Okay, thank you. And Socorro, for you, you're also the supervisor regulator of the insurance sector, so I think this question is appropriate for you. And unlike the other parts of the financial sector, insurance is the protection. We need it. I hope that we never use it, but nonetheless, it's important. So the questioner asks, what do you advise insurance regulators and supervisors to do in order to reduce the effect on insurance companies and brokers in these difficult times?
Oh, God. That's a difficult one. Well, I think the companies are going to have to try to preserve liquidity and try to support their clients the best they can in these circumstances, given some allowance for some delays in payment of premium and things like that.
Thank you for that. Vincent, for you, this is a retrospective question. I think we have touched parts of it, but it's always good to come back and try to elaborate more. So this outbreak has revived my memory of the 2008 global financial crisis. I think has revived many of our memories. I think by this time, most central banks have already implemented some monetary policies to avoid implementation lags, but the effects may take months or years to materialize. Which short-run measures may help? Because I think this will take a few months, and now you've seen what the Fed and others have done. But have all the, I guess, the bullets been fired, or is there other things that still can be done that are relevant?
So a lesson in central banking is you never run out of stuff to do, because you can just do what you've already done in larger size or across across more markets. So don't count the Fed out. I would separate central bank action into two parts. There are those aspects of policies and facilities to improve market functioning, and there are those that are designed to provide macroeconomic impetus. Macroeconomic impetus only works with a lag, and you'd probably think in current circumstances, the Federal Reserve ability to boost the economy is pretty limited. Interest rates were already low before this. Another 25 basis points on the 10-year Treasury yield isn't even being reflected in mortgage rates. And besides, if you are sheltered in place at home, another 25 basis points isn't going to change your behavior whatsoever. So it's not about the macroeconomy. Really, it's only fiscal policy that can give an immediate lift if we can get through the policy implementation lags there, i.e. Congress doing something. The first set of what the Federal Reserve did was to support market functioning. Essentially, if you believe this is a V, that we're in the downward sloped portion as economic activity contracts and people get more risk averse, but you believe there's an upward slope to it, then you also believe that assets sold right now are done at fire sale prices, that they will recover in value. What you don't want is financial institutions, investors to sell in a panic into a fire sale, have losses, which then impair their business models and their ability to function. So what the Federal Reserve is doing across asset class, across groups of investors, basically saying, don't sell your asset, borrow from us at a preferred rate with a generous haircut on the value of those assets. And so that avoids fire sales, avoids the losses, avoids the nonlinear events that make financial crises have a permanent effect on macroeconomic activity.
Thank you. And you know what? We're overwhelmed with a lot of questions. We're not going to be able to get to all questions, but we do promise that the questions we're getting will be one way or another addressed either through the next webinar or through various work and publications that we do. So Socorro, I'm going to pose the very last question to you. It's an interesting one because I know that you and your colleagues who weathered the global financial crisis, and you in Latin America are no stranger to crises in the region, have always been working in stress testing. We at the Toronto Center have done a lot of work on crisis preparedness. So the question is asking, but the question is this pandemic, right? It comes out of a sudden, and our WHO speaker last week said this is the invisible enemy. and we're all beginning to see how, we're kind of slow walking into a depression if we're not careful, forget about a recession. So the question is there a financial tool available which can be used by financial supervisors and regulators to anticipate and stress test the impact of a shock like COVID-19? And I guess this questioner is asking perhaps in the future, like, is there something now that we learned about this that can help prepare us for maybe another pandemic or something, and one of those unknown unknowns again in the future?
As with the trading models, the supervisory models and the bank models regarding on stress testing models cannot capture very well this event. It has a lot of complexities. Maybe a long time in the future, with the uses of bigger databases and access to other things, we may be able to do something like that. But at this current time, all the stress testing models and the parameters are probably not too relevant. So what we are having to rely on is more expert judgment at this time. Prior experience in dealing with financial issues and crises, I think it is more valuable at this point than a specific model.
Thank you. So at this point, I want to thank both you and our global audience. Our speakers, you really kicked ass. I mean, this was a very, very interesting and informative session, not glossy like those TV programs that we see, not sensationalist, but really good information. Thank you for your frankness. This was a difficult conversation. And almost every one of us right now is one form or another in a lockdown having this conversation. Toronto Center will bring another few of these sessions forward on pandemics and financial stability. Please be on the lookout for them. And we look forward to working with you. And also our own office, just to let you know, in the Ontario, province of Ontario, we are supposed to close the physical office at the end of the day today. We will continue working on the virtual mode, but this is the reality for everyone. And I wish everybody a very healthy present and future. And thanks again, and we'll be in touch with you. Goodbye. Thanks.